just sticking to this time frame here, we're opening up with a premium in the sense that we are opening up with a gap from yesterday's close. So we've worked higher overnight, and if you go to your regular trading hours tab, you click on that, there's the gap we're looking at here, okay? So it's a very significant gap. Whenever it's like that, I like to see a little bit of a move to the upside to draw in the public, make them want to chase it. And then typically what it'll generally do, not all the time, but generally, it'll want to move back down inside of that range. And what range am I really speaking about? Let's outline that now. So using the regular session close price here, up to the opening price this morning. So that gap, which is significant, going into this morning, I want you to focus on the potential for just trading back into that range that's shaded here. We're not trying to make the case that it's going to trade all the way back down to 39.8450. That's not an argument I'm trying to pose to you. What I'm suggesting is, can we see a 5-handle price run from wherever we trade up to? And I'm not trying to pick the top. I'm going to let the market indicate that it's stopped, at least for the short term, going higher. I'm not trying to go long. I'm going to try to look for something that gets into that range here. So I'm giving you a directional bias that I'm looking to operate in. Doesn't mean that it can't go higher. Doesn't mean it can't go down to the previous session closing price. Just be mindful that this shaded area here, that's our opening range gap. So where we closed yesterday or previous day to where we open, that's what's being highlighted there. Okay, so when I drop down into the electronic trading hours, that shaded area is what we're representing there. Okay, we already gapped higher. It's already had that initial move higher. There's this consolidation. They broke out. Traders that use this type of idea to buy on a breakout, they're already in this here. The exercise I'm teaching you today, when we get into a setting where there's an opportunity there, because there's nothing here yet. Remember, the first 30 minutes as a trader trading with ES, you want to be willing to submit to the first 30 minutes. It doesn't mean that you can't find a setup. If it's there, if it's obvious, then obviously, then you can. But as a rule of thumb, general rule of thumb, you want to submit to those first 30 minutes. Because sometimes there's reports that come out at 9:45, not today, not every day, but sometimes that occurs. Also, the initial move right off the opening generally is not the right one to be placing yourself in front of risk. So meaning it could be a Judas swing, a fake move. Okay, so we want to allow the marketplace to draw in the gamblers that want to trade in near the first couple minutes of trading. Okay, and you want to just relax, slow down, and remind yourself that you have plenty of time. Plenty of time. You have the entire day to find these measly little 5 handles. And you don't want to rush just simply to get it out of the way, because that's also another thing that you're going to feel like you want to trade. You're also initially anxious about doing it incorrectly. So one of the things you're going to feel is, all right, I'm in front of the charts. I have my account. It's funded or it's real. And I got to just get in here and get it out of the way. So that way I can make my money and close the charts and just be away from it. What you're doing is you're conditioning yourself to hate trading. I went through a phase like that. After a few accounts that I ballooned in the 90s, that feeling of, I just want to get in there and get my money and run away. I was conditioning myself to be afraid of it, which is what made it almost impossible for me to grind through to a point of not being fearful. That's why I have so many execution models that lets me get into a trade. I have lots of opportunities to get into a trade that allows me to participate in a move. And the reason why I have so many weapons like that is because that was one of my strongest barriers. I was afraid to enter because I didn't trust the model that I was working with was a good one. I didn't have enough experience seeing it work. I was in a hurry just because I saw a few of them work, and sometimes they didn't work, but I blocked that part out. And that's another thing you need to be aware of. When you do these exercises and these drills, don't block out the times you do it wrong. Don't do that. You want to make sure that you learn what you did incorrectly in those, and don't try to put blinders on thinking, okay, well, that didn't happen. No, you need to know what you're doing, because if you don't address the issues that you're doing incorrectly, they're going to repeat. And if you're doing it live funds, you know what's going to happen. Eventually, it's going to wear down that equity or wear down your mental capital, and between both of them, you will blow your account. So preservation of capital is the first and foremost important rule in speculation, whether you're doing it with paper trading, demo, or eventually in live funds. So right away, again, we're submitting to that first 30 minutes. Dollar's firming up. It still hasn't gotten above that 103.13 level, which is what I'm looking for. I want to see it get above that on dollar, 103.13. That's the level I referred to earlier. Here's some weakness we're looking for. That right there. Okay, now, right away, your eye should jump to these clean lows right there. You see that? See that right there? Now, what's resting below those lows? Sell side liquidity. This low here, we had a displacement below it. We're trading back up into the imbalance here. Swing high. 4025.75. Okay, so do we offer an opportunity to see 5 handles in this area here to that level here? Yes. Okay, so now what I'm doing is, as I'm watching the ES here, I want to see it drop below, just to trade back inside this shaded area and also gravitate towards the sell side liquidity. And I'm watching the dollar index. There's a small little imbalance that it's trading on. Let me tell you the candle right now. If you look at the 1 minute chart, it is the 944 big green candle on the 1 minute chart. I'm watching, does it respect that? In other words, does it want to send dollar higher while I'm watching ES? So what we would be doing is, the initial drill is 5 for 5. That means you're going to risk 5 handles to make 5 handles. This in here is not as clean as I would have liked to have seen it. I would have rather had not seen that little move here, but I'm giving it an opportunity to see if I can see that run up on dollar on that small little buy side imbalance, sell side efficiency. And again, we're still in that first 30 minutes of trading, so this is all part of that. What are you looking for, ICT? What are you waiting for? What do you look to see? What do you want to find in price action? What is your focus? What don't you like? That's what I'm doing right here. This is how you mentor someone. It's just not blindly going in there and just taking a trade. Now let's just say, for instance, let's play devil's advocate for a minute. Say this starts to break lower. Okay, say it breaks lower and I haven't gotten in yet. I can use the top of that shaded area and the midpoint of this wick here, which would be consequent encroachment. In other words, if it traded down here but didn't trade below here yet and traded back up into it, I don't have a problem with that taken as an entry. Now, you might not be comfortable with something like that. I'm not trying to convince you that that's the model for you. All I'm saying is how do you overcome fear of entry? That's the whole topic of the day. And since we have nothing in here, did I go short? No. Why? Because there's no fair value gap. I wanted to see a small little portion of that down closed candle left open. Then a new candle start, and then it trade up into that. Then I would have sold short right there, targeting these lows. But if I don't have what I'm looking for in the chart, I'm not just going to think, well, I got video games to play. I got to do something here. So dollar index did not respect that fair value gap, which is what I was watching for. It went a little bit deeper than I wanted to see, but it does have a wick. If you look at the wick on the candle 1 minute chart for DXY, the 943 low, that wick on the low end of the candle, we've just dropped down into that. So I'm trying to watch and see if we get some kind of respect there and go higher. But I don't like where we are with ES. So we might need to go one more time higher on ES. NASDAQ looks like it wants to flirt with a higher high also. So, but the Dow is just a dog right now. Let me pull up Dow real quick since there's really nothing here at the time for ES. My focus is primarily on that market. So that's the difference between the Dow on the 1 minute chart. Lower, sloppier. And then on NASDAQ, we have that. So we have relative equal highs. It looks like we could run up in there and hit that. And then ES, we have this. So we have relative equal highs here. Small little gap here. So if we traded down there to that, to 23 to 28, that would be 5 handles. Dollar's just hanging around still, not confirming or denying anything. Still very, very mixed, which is typical ahead of FOMC. So you have to be a lot more nimble on days like this, and also by lowering your expectations. So now think about what's actually occurring here. The market's gapped up at the open. We had a small little rally higher, and we've dropped, but we have dropped aggressively. There was no real energetic drop. See that? The only thing we had here was this drop down here, and it quickly, with the relationships of intermarket analysis with the dollar, it canceled out any short here. And if you missed it, it'll be in the recording. Go back and listen to it. There's the pop to 40.28. So in my mind, I'm thinking anyone that's already trying to sell short the gap higher and the initial high that's being formed here, this run here kills them. So now I'm watching very closely how that dollar index go back to that original fair value gap. That means the one at the candle at 944, 1 minute dollar index. If we rally here, because we cut through candles, we're not supply and demand. Cut through the candles that's been formed over the last 7 or 8 of them. Go back to that fair value gap. The candle we're in right now basically is already traded down into that low of that fair value gap. And I want to see, does it rally higher on dollar? And if that does, this high here on ES could be suspect, meaning that it's just a run on buy stops or anyone short, and then we could look to see it trade into that 420 or lower. But it has to do so in price. All we're doing is anticipating the likelihood of that right now. It hasn't gone below on dollar index. It hasn't gone lower than the low formed at 954. 954 is low. And now we have ES coming back down below these highs here. Okay, dollar's looking favorable now. So now what we're going to do is we're going to wait to see if this high stays in place. If we break lower and create a fair value gap in here, between where? Between this low and the high that's formed. We're using that price leg there. So inside of this range, this is protraction. It's done what? It's taken buy side here with this rally up. So inside of this price leg, we're anticipating now a fair value gap to form. And if it can form, I'll use that one, excuse me, I'll use that one to try to get a run for 5 handles. Okay, so you can see already, like if we were using turtle soup would be that run above and just going in there and, and shorting it, because we have a divergence between the Dow and NASDAQ and ES making higher highs. Dow didn't do that. Dollar indexes nicely ran up into the level I was wanting to see. Beautiful, beautiful. And we do have a fair value gap here. So you can do one of two things here. In your practice, you can set a limit order here at this high plus one tick, and then use a stop of 5 handles, and then use a take profit of 5 handles. Now we have a breaker. Okay, so our attention goes to the down move prior to the secondary higher high. So in other words, in short, the low between the two highs. So where's the down close in that low here? These candles entirely, all of that range. 1, 2, 3. So inside this range, that is a bearish breaker. So let's just say it goes up into this fair value gap here. You can short it, but you have to incorporate this because it can trade up into that as well, because it's a fair value gap within the breaker. So ideally, I'd really want it to trade up into here, but it may be asking too much of it. So I'm going to do a lower probability entry. If we can go right above this high here, I want to see it one more time, pump into that once more. I'll go short, risk 5 handles, and then see if we can get 5 handle run. The liquidity is obviously sitting right below 4014.25. So 401425, all this smooth lows here, there's sell stops resting below that. So if smart money has sold short up here, collecting what? The buy stops. So they sold to those buy stops with this run here. So where are they going to try to get out at? Ideally, market efficiency paradigm is they're going to buy from sellers at a lower price. Market's here. Where are sellers at a lower price? Below these equal lows. I can enter here, but my 5 handles doesn't provide me enough shield where we are in that range with this fair value gap, which is also one of the things you have to contend with when you're trying to take entries. Just because you feel confidently it's going to go to a specific level, you still have to consider the risk. And just because you might be right about where it's going, you can't chase it. You got to trade in a premium if you're going short. That means trading in a up close candle. It's one of the filters that many times is going to serve you better than you realize now. If you can sell short and up close candles and buy and down close candles, you're giving yourself an advantage that most traders don't realize when they're trying to do entries. I want to see it get into this one admittedly. That's what I'm watching and waiting for. Now I just pressed that button. It took forever to get it in there. Okay, and now you just submit to it. If it takes you out, that's fine. If it stops you out, it's fine. And you want to submit to the idea that how much time does it take once you enter the trade? How much time does it take for you to see it move in your favor? Or if it stops you out, how fast did it take you to stop out? Now, obviously, I'm using a fair value gap entry, but I'm using the context of that breaker. So it kind of like allows for more of the things I like to look for in price action, but framing it is, being utilized with other tools. But hopefully you can at least see that the reason why I'm entering is in that fair value gap right here. Okay. Now there's a small little volume imbalance in here. I want to see it trade through that and not get back above it once it does go below it. Now you reduce the risk, put it right above the breaker. That way if I'm stopped out, it's a small little loss. Now all you're doing is studying price action, watching, does it still continuously deliver, wanting to get down into, I have it set to this low right here, But if I had more, let's go back to this idea where the sell side is, okay? But when you're practicing, you want to have a 5 for 5. 5 risk, 5 gain. I want to see it right here stay heavy and go lower. That would be an immediate rebalance. In other words, kind of like a fair value gap return and then drops. I want to see ES remain heavy. And I want to see the dollar climb back up into 103.16 area. My eyes watching how we traded that low. I want to see it trade to that low and expand quickly to get these sell stops. That's what I'm looking for. Just a little bit of a movement up on dollar so far. I want to see it really get aggressive and dig into that 103.16 and higher. Now you want to remove the risk because you've gone into new sell side. If it stops you out at this point, who cares? But because we went to this low here, the market can go back and revisit premium arrays and still not go to that sell side, which is the reason why I removed the risk. You journal your entry suggesting what? All the things positively that you did in the trade, the observations. Now you saw it trade down there, but it didn't take the limit order, and it was way significantly enough below it. They could have done it. There you go. So there you go. ICT's never going to do a live trade. He's never going to call the market. He's never going to explain it, but yet here I am doing it. What you want to do is you want to go through how much time did it take for that trade to deliver. Obviously, I did a little bit more than 5 handles. But, I have to work with what the market's going to give me, right, folks? So right away, you should be thinking, and your corners of your mouth should be aching because you watched all this happen and you can't believe it, I know. But this stuff happens every single day. It's been happening for the last 30 years for me. It's been happening before I was born. Okay, these markets are absolutely rigged. Okay, they're absolutely rigged. There's no randomness to it. The only thing that is going to be random is your emotional impulses when you're not equipped to know how to trade. If you don't know what you're looking for, you're going to lose. If you know a model that you know what you're looking for, then you can aim for that and you can measure your progress. But you're not, okay, you're not going to hit the target unless you have a target. What's the target? Consistency. You're looking for something that repeats over and over again, that's highly precise. I want you to think about the questions that many of you have asked, and you probably are listening and now had the answer given to you. How do you know ICT? How do you know that when it was rallying like that, how do you know that it won't go above that high there? Think about what I went through this morning with you, okay? I opened up the chart. I showed you this shaded area down here. Okay, we'll go back into that regular trading hours there. So the difference between yesterday's closing price and regular trading session to where we opened today at 9:30, that separation, that distinction between those two price points is important. That's the opening range gap. So if we open to a premium, it opens like it does here. It rallies, comes back down, rallies once more. Perfect. Perfect. We're watching now to see that fail. Go back and listen to my commentary. I'm not concerned it's going to keep rallying higher because it's already done enough of that overnight. This is a trap. This down here allows them to do what? Chase it. Longs can say, okay, I missed the initial run up here. Bears go short here. They put their stop loss right above this high. The market drops down into that opening range gap high and then rallies. Go back and listen to my commentary. I did not take the short that I was interested in if it would have kept that candle with a fair value gap. I would have shorted that then. But because I was using the dollar index to filter, it kept me from doing what? Getting in prematurely. Plus, the structure really wasn't all that. It was just not, it was not there yet. So I mentioned that how looking at the other markets, I said, okay, it looks like NASDAQ is looking like it wants to make a higher high. Let's take a look at NASDAQ real quick. So there's those relative equal highs. I said we would like to run up above that. It did that. Look at the Dow. See that divergence there? That's why I was trusting that we were not going to go higher, and that was absolutely a good breaker on ES. So let's go back to ES. I'm answering all your questions. If you just listen to the boring stuff, folks, it's there. but this down closed candle, these series of 3 down closed candles, is the context behind that run up here that stops out anyone that was going short here, because they want to do what? They want to fade the gap, right? Okay. The algorithm knows that. It's going to come down, rally through it. All the buy stops are gone. Why is that useful? Just like I mentioned to you, smart money will sell short to those buy stops. They're going to sell to those buyers at a higher price. Smart money is accumulating. So we're looking at this area here, up in that area, all here. That's where smart money is going short. Okay, so they're selling short there with the expectation that they want to do what? Buy it back at a cheaper price. But who would be willing to sell it to them at a cheaper price? Think about it. Who would be willing to do that? Anyone that's long here or went long on here, it's the idea that this is support, where they're going to place their stop loss, where they just got wrecked. So when smart money's considering entering a short, the market efficiency paradigm that I'm teaching you, the way they engage price, they're not looking at patterns. They're looking at who they can take to the slaughterhouse. They killed the people that were short. When it ran above it, they're done. They're stopped out with a loss. Anyone that was short here gets stopped out. Anyone that went long down here, oh, it's gap and go day. No, it's not. Listen to what ICT said. We're going to rally up, take a new high, and then we're going to watch and see, does it peter out? And it did. The market goes back down and takes out the longs. So who's really right? Who I told you was going to be right. The smart money selling here, and they're going to be buying down here. So when I'm looking at price, I'm looking at this to that. Shorting, buying it back. The context is selling at a premium. If you can't get that price and you're submitting yourself to what? Like I taught in the 2022 model, wait for the displacement. This is the shift in market structure, right below that low. Then we have 2 fair value gaps. You can sell short in here, but you got to incorporate this fair value gap too. Why? Because it's inside the breaker, which is what I outlined here. And the market does what? It rallies up. I am not concerned about it making a higher high because we already have at that high versus this high, the Dow has made a lower high. That's SMT. That's tipping its hand. The algorithm is showing its crack in correlation. It's telling you, much like I was telling you, that this rally is a suspect rally, meaning it's only going up to take the stops out for anyone that's short. Don't believe me? Go back and listen to the recording. It'll be there. But I'm not concerned about it going above that high because I know that the algorithm is going to refer back to that candle's high because the context that books price in this algorithm repeats. It's not random. It's not milling. It's not milling through a whole different range of ideas and retail things. It's not looking for what retail logic is it going to use today. It's going where orders would be resting. It's going where inefficiencies are. That's the only thing it does, folks. That's it. Or it does this, sideways. It's going up for buy side, or it's going up to go into a premium fair value gap, some kind of inefficiency. Or it's dropping to old lows where there's sell side. Or it's dropping down to some discount inefficiency. Now, look at it through the lens of the 2022 model for a second. We see a high. The market rallies up. Did I use any other time frame? No. I traded right off of this time frame here, using the tools that I've already taught you in 2022. So if this market's going up and you're new and you're afraid, I'm afraid to trade ICT. How do I get over the fear of that? Follow the rules. The rules say wait for it to go lower. Where? It's got to go below a short-term swing low. It does so here. Trades below it. Go through. Does it have a fair value gap? Remember the range I told you from here to here? Let's go back up through that. In that range, all of this is protraction. So in that range, when it starts to drop back down, we're going to be anticipating what forming? A fair value gap. There was two of them, here and here. The rules I gave you in the 2022 model last year was if you have two fair value gaps, you have to at least allow for price to trade up into that second one, because it can. But more specifically, because we have that breaker there. Because the breaker is a factor here, we have to at least make an allowance for trading up to the high of that. So I'm not concerned if it goes to that candle's high in one tick or two. I'm not concerned about that. I'm not freaking out that it's going to go above that high. Because if it did that, that's fine. That means I'm going to go bullish now. Because it would erase and cancel the SMT divergence between the Dow and its lower high when the NASDAQ and ES, like we show here, made higher highs. So it would be a stop out on one trade, but it would give me insight into being a net long trader the rest of the day. Because it should not have failed. See the difference between fearing being stopped out and allowing, if it does, then I'll change my bias. That's experience. That's someone that has been here before. And I'm not reacting to price. Did anything that I outlined this morning seem or indicate to you that I was reacting to anything? No. I literally outlined everything you see in your charts here. This is where the price was going to gravitate to. It was going to make a higher high. The model for 2022, if you take the low, well, let's just do it. There's the low up to the high right there. Here's the 50% level. That's equilibrium. So we have to find something as a discount below that level. Well, we have these lows, this low, and then these relative equal lows here. Which one's more likely to have the bigger pool of liquidity below it? Obviously this one here. And it's nicely below the 50% level. So we're in a discount, and we smashed all the way down into it.